So I'd like to structure the presentation basically three parts. I'd like to very briefly link the leverage cycle to what at the BIS we term a financial cycle, which I think is a broader concept, and they both have their uses, but actually not very distinct. Then I would like to discuss Christoph's paper, and then I would like to discuss policies which could be used to tame leverage cycles. Now, leverage cycles and financial cycles. So at the BIS and also in a part of Basel III is sort of the concept of a financial cycle, and it's a bit of a vague concept. It sort of refers to joint fluctuations in a wide set of financial variables and has to include quantities and prices. And the leverage cycle is one particular manifestation of a financial cycle. It's more microeconomic in nature. It's, I think, pretty good at capturing fluctuations at one particular type of institution. It's quite good in order to see these self-fulfilling cycles. It may not be as good for predicting crisis or for defining the macroeconomic fluctuations, but I think that's of a matter of you maybe use one or the other. It depends on what you're working on. Maybe some three stylized facts on financial cycles, and a lot of them apply to leverage cycles as well. So financial cycles tend to be much longer than business cycles. They tend to last 15 to 20 years rather than 1 to 8 years. The peaks in the financial cycle very often coincide with banking crisis or with periods of financial distress. And that's very important. I mean, there must be something in these cycles which actually leads to financial distress. And they have implications for output, obviously through financial crisis, which are very costly for the real economy, but even in the absence of a crisis. And I'll show you some evidence there. And the way that works, and that's recent work by some colleagues at the BIS, Matthias Drehmann and Mikael Juselius, who's now at the Finnish Central Bank, is you've got two constraints which actually link the real economy with the financial variables. And one of them is a collateral constraint. So the value of a collateral, for instance, the value of your house determines how much you can borrow. And that has been modeled quite widely. But there's a second constraint which has not been modeled very much, and that's a debt service burden. And that is how much of the fraction of your income do you actually devote to debt service payments? And I trained as a banker before going to college, and that was actually the first thing. We actually looked at this first before looking at the value of the house. And it also applies to corporate loans. So you actually look at the cash flow of the firm and then decide, okay, how much can this firm afford? Which level of debt at current interest rates or at stressed interest rates can the firm afford in order to so that no debt overhang problems arise? And that's hardly ever modeled, but it's actually very important. It's actually a crucial thing, linking credit to growth. And if you actually look at, I mean, this is something which is not just my own background as a banker in Germany, or it's actually something quite universal, because if you look, for instance, at securitization handbooks of mortgages in the US, they all have these two constraints. And from these two constraints, why do they matter? We can actually get two long-term relationships. The first one is between asset prices and credit, and that comes from the collateral constraint. So if asset prices go up, there's scope for more credit. If asset prices go down, you may have margin calls in some types of loans. You may not have new loans in terms of, say, mortgages or smaller loans. And the second long-term relationship is between credit, lending rates, and GDP, and that's from the debt service constraint. And Matthias and Mikael, in their working paper, they show actually that these long-term relationships can explain why growth in the US before the Great Recession was actually not that high, and the subsequent sluggish recovery. And I show you a graph. And please look at the right-hand panels. Sorry, it's a bit small, but at least it's bright colors. So what they do, they basically estimated a model, a co-integrating model between asset prices in the US, credit, and a few other variables. And they stopped the model in 2004. And then they made predictions. And the blue line on the right-hand panel, that's the level of GDP they predicted starting at the end of 2004. So what the dynamics of these two constraints, of the of the collateral constraint and of the debt service constraint, predict is that as U.S. households accumulated more debt, or U.S. firms, well, it was mostly households, accumulated more debt, they would dedicate a higher part of their spending to meeting mortgage payments, and they would consume less. And then this would depress consumption, and you would actually have a point where this consumption would turn negative, and would actually, in these simulations, would actually fall to, I think, I forgot what the scale is, but you would actually see a drop in consumption in 2008 without any crisis, which is about half of the drop that we actually saw after the Lehman failure. And then you would have a fairly gradual recovery, and it would take until sort of 6-7 years later that you would actually get to the pre-crisis level, which is of the dotted line. And that you get mostly from this debt burden constraint, or this debt service constraint. And yeah. So financial cycles matter a lot for the real economy. You can also use financial cycles for crisis predictions. Peaks in financial cycles tend to be associated with banking distress, which means that a stage of financial cycle should have a predictive power for banking crisis. The problem is that financial crises are very different from one another. This is something I did some years ago. We tried to cluster financial crisis, try to find similarities, and don't look at this in too much detail. The main point is that there's no clusters, that financial crises are very different, that there's no typical financial crisis. They've got some typical elements, but they come in various guises. And that means, and I think all your complexity people should know that, and well know that, is sort of these very high-powered model with lots of variables which predict all crises within the sample period are probably not very good at predicting the crisis out of the sample. So we need to have very simple, robust indicators. And what we did is we did a horse race of various indicators and focusing on single indicators. And we found that the credit gap, which is the deviation of credit, economy-wide credit from long-term trend, is the best single predictor of banking crisis in the next 3 years. Now, you can get higher predictive power within any sample if you combine more variables, but this is sort of something, if you do it out-of-sample analysis, this is sort of the best single indicator. And if you get closer to what tends to be the financial crisis, the debt service gap is actually something very important. That's the deviation of debt service burden from its long-term average. So if the debt service burden of households and firms increases rapidly, then more likely than not, or increase above a certain threshold, more likely than not, you're going to have a financial crisis within a year. And we use that in order to sort of provide early warning models of various economies. This is from our annual report. And the red numbers are basically, they show that with sort of, I think, 2/3 probability you'll have a financial crisis in the next few years. And it looks very red indeed, unfortunately, this graph. So I think we need to worry. Now let me turn to Christoph's paper, and what the paper does, it basically shows that risk management tools, similar to those implemented by financial institutions today, can lead to leverage cycles. And there's two key ingredients as I view it. And the first one is that you have leveraged investors, which they call banks, and they set their leverage targets as functions of estimated volatility. And they're using backward-looking models for volatility estimation. Now, these two ingredients, they're not derived from first principles, but actually reflect industry standards, and some of them can actually be derived from first principles as neoclassical economists, and I consider myself to be one, and maybe the only one here, quite like to do. So I think these are reasonable assumptions, and they have a very powerful implication. And they lead to leverage cycles. So this simple model can generate leverage cycles. And I think with the stochastic case, I think this is a great result. I can even understand some of the intuition. And one of the mechanisms is that once you lever up a lot, you need a very small shock and bad things happen. And then you are forced to sell into falling markets and everything collapses. Now, that's fine. In the deterministic case, I'm not so sure. I mean, this is basically, you can sort of get, in the deterministic case, you can get leverage cycles as well, and that's because you sort of provided some language in the paper, which the system approaches a hyperbolic fixed point where the leverage is so large that a crash occurs. That's not very useful for me, this language, so I would welcome a better explanation or something, a more pedestrian explanation with some intuition. Now, I think this hinges on the fact that banks are absolutely myopic, and even if they're on the precipice, they're myopic. And that's where maybe I'd like to react to the presentations on the first part of it, so where you sort of ask for a new paradigm. Actually, if we replace the neoclassical paradigm with another paradigm, I think we're not really better off, because we should, rather than having paradigms, we should have multiplicity of areas. And for that to succeed, we need to talk to each other rather than making statements about how bad the other paradigm is. But maybe that's strongest statement. So I think you need some forward-looking models there and some story, some narrative in order to show that. Otherwise, this thing is not convincing, at least not to me, and will not be used in policy. I think that's pretty straightforward. Now, what can we do about leverage cycles? I think some procyclicality may be unavoidable. So VAR-type constraints, they actually, under some conditions, are optimal from a bank point of view, and it doesn't matter whether Basel 1, 2, 3, or 4 actually has them in there. They would use them anyway. And just to remind you, I mean, the crisis, Basel II was actually not really implemented in the years before the crisis. Now, there was some transition to Basel II, but certainly not in the US. And so blaming the financial crisis on Basel II is maybe a little bit in terms of anticipation, but it's a bit far-fetched. Now, it did reveal shortcomings of Basel II. I think that's something completely different, and that's a point well taken. But in financial crisis, what we see is that only well-capitalized institutions obtain funding, which means there's a market-implied capital ratio, and that's a risk-based capital ratio. And no matter what you do in regulation, this is the ratio, this is the capital ratio which is binding. So after the crisis, there was a lot of talk about Basel III capital ratios being too onerous, but what people oversaw is that at that moment, for a bank to get funding, they needed to have far higher capital ratios than what was put in place by regulators. So you will have some procyclicalities, and we can't do anything about it. And regulatory capital ratios may not be the real constraint in the sell-off moment. And it also means that some countercyclical capital regulation, and here the disclaimer applies, this is my views, it's not necessarily BIS views, capital buffers or countercyclical capital regulation may actually not work for that reason, because you simply can't get away with loosening capital there. Now, what can we do? We can have tight leverage limits. What you have is low leverage, so we actually have pretty onerous regulation on leverage, and that reduces cyclicality also in your model. We can have an acyclical leverage ratio as a backstop, as in Basel II, so Basel III. So Basel III has two ratios, has a risk-weighted capital ratio, which is inherently procyclical, but it has a much less cyclical leverage ratio as a backstop. We can make leverage more expensive, but don't cap it outright. Now, this would slow the adjustment to a leverage target, and I think that, for me, was the most interesting result that you have, because that's something which is not as widely known, that if you don't react very quickly to these, if you have time in order to survive, to build up your capital, then the system becomes much, much more stable. And we may want to find ways of doing that. Now, what I said before about market-implied capital ratios applies here. I don't know how feasible it is, but I think that's something we should explore. A technical thing, I think we should extend the horizon of volatility estimates. This would maybe not get rid of the leverage cycle, but at least we could extend the length of it. Or we should maybe force banks to use crisis data and volatility estimation. And that's something which I think was a big issue before the crisis, that the models used to estimate volatility in the banks are just very, very short, the horizons. Typical BIS point of view, we should think about using monetary and fiscal policy to lean against financial booms. There's a lot of debate about it. I think we shouldn't. The issue hasn't been settled, but we shouldn't really settle it prematurely. And that's it, I think. Thank you very much. It was really interesting.
Thanks a lot.